What's going on, YouTube? We are back. Bo and Kendall here.
Bo leaving?
Kendall leaving.
Woohoo! I'll say that last name.
Welcome to Leaving Class 101. Today we're going to talk about assets versus liabilities. But before we get into that, make sure you subscribe to our channel down below and you like this video if you love it.
What is an asset? And for the most basic deal to tell you what an asset is it puts money in your pocket. It makes you money.
True.
What is liability?
A liability is something that you pay on and it doesn't make you any money. No cash flow, nothing. You pay on it most of the time.
Yep. Boom.
So you're the asset.
So, for example today, the reason why we wanted to show you this is because this question we do get asked a lot, or we were also confused too when we were first started of what do we do, because honestly, I was told too a lot in my life that you should go out and you should pay, cash for your vehicles, and you should pay for all those liabilities in cash because then you don't have those payments. Well, the problem is if you're using all your cash all the time, how are you going to go out and do more deals? So we were raised on two different ways with two different mentors of pay cash for all those liabilities, and then we got somebody else over here telling us that no, don't do that. Use that cash for your down payment on your investment property to pay for that liability.
Sure. So we broke it down pretty simple for you. A couple years ago, we bought a rental as an investment property, and we're going to show you, what it made us per month, how much we had to put down, versus if you want to go out and get a vehicle at the same time. Because say that you need both. Say that I have this and I want to go and invest in this property, but I also need a new truck for work or whatever. So we're going to break it down for you.
Yeah. So instead of, say you got the cash in your account and you're like, man, I need that, like Kendall said, I need that new truck. And you're going to go up to the dealership. Well, most dealerships are going to do no money down. But you say you got this other mentor over there telling you, right, Kendall, you need to go and pay cash for that truck. There's no sense of you having a $500 or $600 a month payment, I can't even talk right now, on your vehicle, right?
Right.
Well, once you do that, right, your cash is gone.
Yeah.
So if I call you tomorrow and I say, hey Kendall, I know you just bought a new truck, but man, I got this house for sale and I'm only asking $40K and I already have a tenant in there right now rented for $800 a month. And that's a low number here in Amarillo. Really low number.
Sure.
So I call her and she's like, well, Bo, I can't. I just spent all my money on my truck. And now she's literally just paying out $600 a month for her truck payment.
Yep.
Versus, right?
Versus you can have two for one.
Yeah.
Yep.
And so why do that? Why go and take on $80,000 in debt? Well, here's the reason being, and this is what's worked for us in the past. That's what's really working for us right now. So I go over here and say I tell Kendall, and she ends up buying. Well, I'm going to wait on that pickup, but I'm going to come over here and I'm going to get this investment property. So she met with the bank. She's already pre-approved, and most banks are going to require 20% down on your investment property. So Kendall's going to need $80,000 to put down on this project, or this property. Well, she goes to the bank, she gets it done, she buys it. Well, then I turn around and I hand her the lease because I already had this thing already rented out for the year. On a 15-year note, she's paying $245 a month, right? And that doesn't include your taxes,
right.
But on a $40,000 house, not very much at all. And it's a 2-bed, 1-bath, and right now, Kendall's pulling in $800 a month in rental income from that property.
Sure. So your monthly payment's $245. You're getting $800. You have a profit in there of $555 a month. That's pretty good.
Yeah.
So say you go over here and you really need the truck too, and it's $40,000. You're going to put no money down on that, because if you put money down on this, your payment on a 6 year is going to be $590 a month. So this investment property pretty much pays for your liability.
Yeah. And that thing, and this thing, in 15 years, then eventually you're collecting the full entire amount for rent. And that's the reason why we're big on real estate, because we were always taught is you buy a asset first, invest your money first, and then use it for your liabilities. Because then right now, like Kendall, she's going out and buy this property, she's making $550 a month profit from this deal, and she still has that brand new truck, and so then she's barely using any of her own cash per month on this truck payment over here.
Sure. And say that you still want to build up your cash flow or whatever, the more assets that you acquire, the more cash flow you will be bringing in, because you're paying on this covers this payment. Get more assets, then that'll be positive cash flow even more, to where you can keep profiting money.
Yeah. Yeah, and then the bank loves it too. So like say the bank, you know, you go do this deal one time and all of a sudden, you know, a year later, like, wow, you've made your payment every single month, the first, just like, you know, you're awesome. So you know what, Kendall, I'm gonna give you, let you do another deal. And Kendall's like, well, I got 8,000 more bucks, so I'm gonna go out and buy another property. Well, say you did that again. The same thing, 800 bucks a month, right? On this property. Well, now you're over $1,000 a month in profit on these two deals. And like Kendall was saying, that literally pays that plus an extra $500 a month. And
so, positive cash flow, acquire more assets than you have liabilities.
boom.
Simple.
Oh, high five to that one.
Leaving class 101 success.
But hopefully this helped you. If you have any questions at all, feel free, hit us up, subscribe, like the video. We love you guys.